Every time the market crashes, you see the same headline, $3 trillion wiped out in a single day. And most people read that, feel their stomach drop, and either panic sell everything or just try not to look at their portfolio for a week. But here's the question nobody actually stops to ask. Wiped out and sent where? Someone's pocket? The government? Just gone forever? If you don't know the answer to that, you're flying blind every time the market turns red. So today, I'm going to fix that. By the end of this video, you'll understand exactly what's happening behind the headlines, and you'll never look at a market crash the same way again. So let's start with the first one, the big misconception. Let's start with the headline itself, because the language is fundamentally wrong, and it's the root cause of most bad decisions people make during a crash. Trillions wiped out makes it sound like someone opened a vault, took the money, and left. But that's not how markets work. Stock prices aren't cash. They're a valuation. What the crowd agrees something is worth right now at this moment. And that number can change without a single dollar actually moving. Here's the simplest way to think about it. Say a realtor tells you your house is worth $500,000. You feel great. A year later, the market cools, and she says it's probably closer to $420,000 now. Did $80,000 physically leave your bank account? No, nothing moved. Only the estimate changed. Stocks are identical. A company has 10 million shares. The price drops from $50 to $40. Headlines scream that $100 million was destroyed, but nobody transferred $100 million anywhere. The crowd just decided those shares were worth less today than yesterday. Market cap isn't a bank balance. It's a live auction price multiplied across every share that exists. So before we go anywhere else, that's the foundation. Most of what disappears in a crash was never sitting in a vault to begin with. Now that we've established what doesn't happen, let's talk about what does. Because the money doesn't just sit there in limbo. It moves. It just moves in ways most people never see. But before that, if you like more content like this, make sure you subscribe to the channel so you don't miss out on any future videos like this one. And I hope you enjoy the rest of it. Okay, back to the video. The first place it goes is into safer assets. When stocks sell off hard, real money that was in stocks gets rotated out into cash, U.S. Treasury bonds, money market funds, and sometimes gold. During the 2008 financial crisis, there was a massive global flight out of stocks and into U.S. Treasuries. That's what financial news means when they say money is leaving the market. It's not disappearing, it's hiding. It's sitting in a money market account waiting for the panic to end, waiting to come back in at lower prices. The second place the money goes is far more interesting, and it's the thing that changes how you see crashes forever. For every person selling in a panic, someone else is buying. Every single stock transaction has two sides. When you sell at $40 because you're terrified, another investor bought at $40 because they think it's on sale. This is what a crash really is, underneath all the noise, a wealth transfer. Not a destruction of money, a redistribution of it, from the people who blink to the people who don't. Benjamin Graham, the man who taught Warren Buffett everything he knew, said it best. The market transfers money from the impatient to the patient. That's not poetry. That's literally the mechanics of how a crash works. Here's where it gets important for you personally, because there's a distinction most people miss entirely. For a regular investor with no borrowed money, a market crash is mostly a paper event. Your portfolio number drops, it looks awful, but nothing real has happened to your money yet. You still own the same shares. The only thing that converts a paper loss into a real loss is if you sell. But there's a mechanism that forces certain people to sell even when they desperately don't want to, and it's called a margin call. Here's how it works. Imagine a hedge fund borrows $900 million to buy $1 billion worth of stock using only $100 million of their own money. The market drops 20%. Their $1 billion is now $800 million. The bank that lent them the money says, your collateral is shrinking, give us more cash or we're selling your position. The fund doesn't want to sell, but they have no choice. The bank sells it for them at whatever price the market will bear in that moment, and that forced selling pushes prices down further, which triggers another margin call somewhere else, which triggers more forced selling. That's the domino chain. That's why crashes sometimes spiral in ways that feel completely out of proportion to the original bad news. This is also where real permanent losses happen, not just for leveraged institutions, but for regular people who owned stock in companies that actually went bankrupt. Enron, Lehman Brothers. Those shareholders didn't just experience a repricing, the underlying business became worthless. That's a different situation from a broad market crash, and it's worth understanding the difference. If you're a regular investor with no margin, no borrowed money, you have the single most powerful position in a market crash, the ability to do absolutely nothing and be completely fine. So what history actually tells us? Let's put some real numbers on this, because this is where the theory stops being abstract. The S&P 500 has crashed, meaning dropped 20% or more, 13 times since 1950. The average decline is around 33%, and it typically takes about a year and a half to reach the bottom. Sounds brutal, but here's what the same data shows on the other side. The bull markets that follow crashes have been bigger, stronger, and longer than the crashes themselves every single time. 2008 is the clearest example. The S&P 500 dropped about 57% from peak to trough. If you sold at the bottom in March 2009, you locked in the worst loss of a generation and missed what became one of the longest bull runs in market history. If you bought in March 2009 or just did nothing, your patience was worth a decade of outsized returns. 2020 is even striking. The market dropped 34% in just 33 days, fastest crash on record, and then it recovered to new all-time highs in 6 months. The people who sold in March 2020 locked in their losses. The people who stayed put were fine by September. And here's the stat that should make anyone think twice before hitting sell. If you missed just the 10 best trading days in the market over a 20-year period, you would have cut your final portfolio value in half. $64,000 becomes $29,000 just by being out of the market on 10 days out of roughly 5,000. The painful twist, 7 of those 10 best days happened during bear markets. If you flee during the crash, you almost certainly miss the recovery. You absorb all the pain and none of the gain. So here's what you should actually do with all of this. Here's the practical part, because understanding where the money goes is only useful if it changes your behavior. First, stop treating your portfolio balance like a bank account. That number on your screen is today's auction price. It is not money you've lost until you sell. Checking it every day during a crash is like checking the value of your house every morning. It'll drive you insane for no reason, and it won't change anything. Second, ask yourself one question before you do anything. Do I need this money in the next 2 years? If yes, it probably shouldn't be in stocks in the first place. That's a risk management problem to solve before a crash, not during one. If no, you have time. And time is the only thing that separates panic sellers from patient buyers. Third, remember where you sit in the ecosystem. Are you someone with borrowed money, a margin account, leverage? Or are you a regular investor who owns what they own outright? If it's the latter, you have the single most powerful position in a market crash, the ability to do absolutely nothing and be completely fine. A crash is effectively a Black Friday sale on every stock in existence, except instead of fighting through the doors to get in, everyone's sprinting for the exit. The question is simply which direction you want to be moving. So let's bring this together. When you see trillions wiped out, that's a repricing, not a cash bonfire. Real money rotates into bonds, cash, and gold. It doesn't evaporate. Crashes transfer money from panic sellers to patient buyers. Forced selling from margin calls is what makes them spiral, and if you have no debt, you're not in that chain. And missing just 10 days of market rebounds can cut your lifetime returns in half. The market is not a place where money goes to disappear. It's a place where money moves from people who don't understand what's happening to people who do. Now, you're in the second group. And also, market crashes really don't matter if you have a great ETF portfolio to begin with. So if you want to know more about building a gigantic ETF portfolio, make sure you watch this video as well.